Hello, ladies and gentlemen, this is Greg McCloskey, and this is a Forex commentary for FXStreet.com for Monday, October 25th, 2010. Now that the G20 meeting is over, the dollar has continued to get weaker against the major currency pairs. There are a couple of reasons for this. One, the Treasury Secretary Geithner's idea of trying to control the global trade imbalances by imposing a limit as far as from of a trade deficit or surplus, and that did not gather any steam over the weekend meeting. In addition to that, the market or the G20 decided that the better course of action was to have a comment about the competitive devaluation of currencies was not going to be looked at as a way to get through the economic crisis, that they would prefer to have floating exchange rates, and this led to the dollar yen moving lower, as the Bank of Japan certainly would not then be expected to intervene in their currency as they did on September 15th of last month. And as a result, we did see the dollar get not only weaker against the yen currency pair, but we also saw movements into the risk currency pairs, the emerging currencies that have been that we've seen some devaluation or competitive devaluation from those countries like Brazil in an attempt to stem the rise in those currency pairs over of late. But that seems to have abated, and we're seeing the sell-off in the U.S. dollar. So why don't we take a look at some of our major currency pairs from a technical basis, and we'll start off with the euro versus U.S. dollar. And this currency pair moved above what I consider the confirming moving average. That is the 200-hour moving average. Over the last few weeks, the market has been in a very non-trending type period here. We did have a move above the 140 level at this during these two trading days, and a move below the what I consider our floor here, 137.75. Most of the activity has been within this range right here, and until today, will the market move back above that 140 level and start to develop some value above that level. But since the New York opening, we have had a more of a contained market here for the euro versus U.S. dollar, with the market peaking in the New York session around the 140.44-ish type area, and the low has been down to 140.01. So the market is still trying to figure out its direction. We do have existing home sales coming out at in a little while here in the United States, and that may help in the direction for the euro versus U.S. dollar. Off the 5-minute chart, you can see here how the market shot up in early, the early session in the Tokyo trading range, moving up toward the highs during the early London session, and then kind of consolidating. In fact, maybe coming down over from that time period. We can put a trend line that connects the tops here, and the market has remained below that line here, and during the New York session, and we also have remained fairly below, pretty much below the 100-bar moving average on the 5-minute chart for most of the New York session as well. That level comes in at the 140.39 level, and the trend line currently comes in at 140.41. So we know of the resistance up above, and we found the sellers on the last rebound to the top side. Now this green line is a 200-bar moving average on the 5-minute chart, and remaining above it gives the market this neutral stance right here. The other key level would be the 140 to 06 level, which represents again that off the hourly chart. We've had a number of different lows and highs at that 140 level going back in time. You can see high here, we had highs here, low support here, highs against that level here, and all of it comes in around the 140 to 140.04 level. So we'll be watching that level on the downside here, and as our key support level. If we break below that level, then we could see further liquidation down toward the 139.70 level. Our closing on Friday was around the 139.30 level, so we're far away off from that level. But if we do break below the 140 level, we could see some further pressure in the euro versus U.S. dollar. Take a look at the sterling versus U.S. dollar, and here we have the 100-hour moving average. In the last few hours, the market's been able to stay below that level, not close above it. We did have a few little tests above it here, but each time the market failed. 157.39 is going to be our key level, currently trading at 22 for that currency pair. Stay below that level, and could see further pressure in this pound versus US dollar. This pair has been under a little bit more pressure than the euro. Once again, they are expecting to have some quantitative easing coming out of the UK, Bank of England, going forward as a result of the sharp austerity package, 19% cut in government spending. So we'll be watching that closely. Overall, for the sterling versus U.S. dollar, can stay below this blue line here, as we have for most of the of this period here. Well, we've had a few little bars above it. Then the bias remains to the downside for these this currency pair. 157.36 is that level. The dollar versus yen, I mentioned that that level had that currency pair has come under pressure here, and we moved below the 80.84 level. That was this lows here, 88 at these two points, 84 on this day. Moved below that 84 level. Haven't been above that level since. We've also haven't been above the 100-bar moving average on the 5-minute chart. That level currently comes in at the 80.62 level. Stay below that level, and the market could continue its move to the downside here for the dollar versus yen. Long term, we do have this trend line on the bottom side here, connecting these two lows. You can see that it's held support around this area. We've had some buyers against that level. That level currently comes in at around the 80.06 level. Keep that level in mind on the downside here. I know it's not close, trading at 80.50, but if the market should gain some more momentum to the downside, watch the 80.06 level. Watch the 80 level is going to be a key support level as well for that currency pair. The dollar versus Swiss franc, the 100-hour moving average in this currency pair has been tested a number of times here over the last 8 or so hours. 96.84 is a key level here. You can see how the market would dip below that level and move back higher, so that's encouraging for the dollar versus Swiss. Let's get above the 100-bar moving average on the 5-minute chart, the 96.97 level, and that would give me a little bit more confidence in that currency pair. That's a dollar versus Swiss. The dollar versus Canada, we have oil prices up here today, and this has given the Canadian dollar a boost to the downside. The dollar, and in addition to that, the dollar versus dollar weakness has also led to that move. The 102.05 level is a key level for me, and the dollar versus Canada, that goes back to this low, going all the way back to October 2009. We spiked off of that level, found support against that level, and then used a level as resistance. Each of the time the market has come down through or by that level, the market has had either rejection of the move below, rejection of the move below, rejection of the test, move back, move below it, and move to the downside. Now we're back below that 102.05 level, and it looks like the dollar versus Canada is coming under pressure. We also are trying to move below the 200-hour moving average. It's a green line in this chart. That level currently comes in at the 101.73. So this is all. The dollar seems to be continue to get weak after the weekend comments and the G20 inability to have any sort of key rebalancing decisions in regard to China, and as a result, we are again focused on the quantitative easing in the U.S. and the U.K., which are pressuring those currency pairs. Commodity currency pairs continue to remain fairly strong. Dollar Canada as evidence of that. This is Greg Mikulowski with a Forex commentary for FX Street.